Hey everyone, today we're talking about one of my favorite stocks, BATS. I just added 0.5% to my position, which means it now represents 10% of my eToro portfolio. So please go to the link in the description to go check out my eToro portfolio. I want to talk about the incredible financials of this business and why I added to the position today. And then that's it. So this shouldn't be long. Even though I hate cigarettes and I hate e-cigs, I do love the BATS business. One of the reasons this cigarette business is great for retail investors is because, like their products, their shares are toxic to pensions and hedge funds. Pension schemes and hedge funds like to project an image that their investments not only are financially profitable, but they're also investing in a greener, brighter, happier future. For that reason, BATS is often pushed aside by a lot of big financial institutions. This is the same investment philosophy that works for oil companies, but I personally feel like there's more cash for investors in stinky cigarettes than there is in sticky oil. Okay, so with that said and done, let's get into the numbers that matter. This is the price to earnings, the dividends, and the debt. BATS have a price to earnings of 6, so that means excluding dividends, in 6 years, you'd have your investment returned to you in earnings. So if you invested £1,000, in 6 years, you'd have £2,000 in total, excluding dividends and excluding inflation and growth. We're going to get into all of those things, but by comparison, other companies with the same level of growth as BATS can be typically valued to return your investment in 20 years, not 6. I like to do comparisons to the super safe savings account. The best savings account in the UK right now is the NS&I 6.2% fixed rate for 1 year. I don't think I've seen that interest rate in over 10 years. And yet, if you continually could invest in that, it would take 11 years to return your investment. The only benefit is it would be guaranteed. Also, going back to British American Tobacco, their dividends are one of the main reasons you should consider investing in this stock. This is the cash they give to reward shareholders who are holding the stock. While the dividend payout typically stays the same, if the share price goes down, the yield you can get on each share is going up. So when I first bought this stock, the dividend was around 5 to 6%. However, after the share price has taken a little tumble, it's now at 8%. So ignoring everything else, if you invested £1,000, you could potentially be getting £878 annually. Finally, free cash flow. This is my favorite number. This is the amount of money a business has after it's paid off all of its debt and all of its expenses. It can usually be found in the cash flow section of a company's financial reports. To give an example of free cash flow, if you are renting out a house, free cash flow is the amount of cash that you'd have after you paid your mortgage, fixed the roof, and paid the plumber to fix the hot water. To me, it is the truest form of value. After all, what we really want from investing our cash is more cash. And so BATS free cash flow is 9.78 billion. And given the business is currently valued at 58 billion, that means their business is currently priced at 17% free cash flow. To go back to the house example, let's say you bought a house for £300,000. A 17% free cash flow rate would mean that you're making 50k a year after you've paid your mortgage, after you've paid your taxes, and after you paid all your expenses. Imagine if you're making 50k per year after buying a £300,000 house. So guys, what's the catch? There's always a catch. Well, like a lot of the stocks I hold, it's debt. Back in 2017, BATS bought another American tobacco company, and that means they have 40 billion to pay in debt. All I can show you on this is that since 2017, their debt has been going down steadily and their equity has been going up. To be honest, I'd double my investment if they announced that they were cancelling the dividend and just focusing on paying off this debt. Currently, according to Simply Wall Street, their interest payments represent around 25% of their cash flow. So unless that moves up to around 50%, I'm not worried. I'm going to have I'm going to finish this cup of tea. Remember that if you like this video, please like and subscribe. And also, if you have any additional comments, feel free to leave them in the comment section. I will answer every single question in the comment section. But also, if you want to chat to me more directly, you can go to my Discord, link in the description. And yeah, that's all from me. Thank you very much. Goodbye. Okay, that's very cold. It's very cold.